Hello, welcome back to the continuing lecture in investment analysis. This is Dr. Jeff Hong, and this is the first session, first video. And in the previous, first session of the lecture series. Okay, we had a previous session, which was just overall intro or overview of the Blackboard course. So the first topic is bond pricing, bond price and bond yield. And of course, we've already covered extensively about bond in the Principles of Finance, FMB 100, right? If you have taken FMB 100 with me, you have very solid foundation. You must have had a very solid foundation. I mean, it's been several semesters. You say, oh, well, I forgot everything. But, as we go over this material, it will be reviewed. Some of it will be reviewed. Most of it will be reviewed, but, everything will come back. But, it's very important that since you have already taken Principles of Finance as a prerequisite to this course, it's important that you stay focused on the mathematical rigor of this topic. I mean, every topic is it goes without saying, every topic is based on mathematical rigor, right? Now, so in the as you're watching this video, you must have also found a couple of other files in the topic folder, right? The first file would be the PDF version of this file, this PowerPoint that you're now looking at, and then there's an Excel file for the exercise, and then down below there are lots of other files. Some of them are I posted. Some of them are like bond basics, or the files that we used in Finance 100. So if you feel that you still need to be properly tuned, you can always go back to those files and prep yourself. Okay. Now, but let's take a look at this slide. Starts from, of course, from the cover. The cover is slide number 1, but we're at slide 9 because we're not going to go from slide 1. It's unnecessary. What's more, what's more crucial is the bond pricing, a bond valuation model, and this is a sort of review of what we did in Finance 100. Now, everyone remembers that bond okay. So everyone should remember that the bond valuation formula is basically uh, uh, it consists of two formulas, right? One is present value of annuity, right? This is the present value of annuity part, and this is the present value of the maturity value, right? So this is the present value of annuity because bond consists of bond value consists of uh, present value of coupons, and coupons are annuities. Remember what annuity is? And because coupons are, paid at regular interval, and the par value or the maturity value, which is always $1,000, right? Um, this is, this needs to be discounted to time zero or present. So this is the present value of a single cash flow, single sum, and this is the present value of annuities or multiple cash flows, right? And the formula for present value of annuity, right? Formula for present value of annuity is payment over rate R minus payment over R times 1 plus R raised to N. Now, of course, payment is just uh, generic notation. In the bond context, that payment is coupon payment, right? And you all remember that coupon is semi-annual. Coupon payment is semi-annual, right? And then coupon payment is semi-annual. So if the time t the uppercase T is always time to maturity, or because uppercase means terminal time. So if your bond has 10 years left, what does that mean? There will be 20 coupon payments. So actual number of compounding periods is not 10 but 20, right? So because bond is on semi-annual cycle, right? So the uppercase T, although it is 10 years now, actually the N, right, will be, right, 2 times T, right? And time is usually number of years, right? This may not look like a okay. So as I said, if the maturity, time to maturity is 10 years, then there will be 2 times 10, in other words, 20 semesters. And, because you're collecting interest and coupon interest, right? Coupon payment every 6 months, right? So this is briefly, we already know how to do this. And the coupon, and this is another way of expressing it, annuity factor. We're not using any. Some people who didn't take Finance 100 with me may resort to interest factor table, especially people who did accounting. Still, use factor table. No, we don't use factor table because that's outdated. That's like, early 20th century method. We are in early 21st century. We don't need to go back to the, 100 years back, right? There are people who still use factor tables. If you go to like some loan, um, loan brokers, loan mortgage brokers. If you go to mortgage brokers, office, they and very old people, who practiced, loan origination, mortgage origination from back from 1970s, or even 60s or 80s. They still have a big, chart, and they call, it's interest factor table. Still, locating the interest factor by, finding coordinates, longitudinal and latitudinal rates, time. But that's look. We have computer. We don't need, and that's it's inaccurate. First of all, doing it by table, it's inaccurate. Anyway, and we can do it. We will do it in Excel in two ways. We did it also exactly like this in Finance 100. There are a couple of things I will briefly mention. The price quoted, right? Let's say, so if you calculate the bond price, right? The bond price, I use, uppercase B for bond price, but sometimes P sub B is used, P subscript B, but P subscript B and uppercase B are used, they actually refer to two different things. Why? They can be, first of all, uppercase B is the rational price of the bond, or fair value, or intrinsic value. Okay, fair value, intrinsic value, or rational price of the bond. And you learned this in Finance 100, especially from me. But the P subscript B is the symbol for market price. And what's the difference? Of course, there's a difference between the fair value and the market price. That's why everything is not exactly fairly valued. In the financial market, most of the times in the short run, everything is either slightly overvalued or slightly undervalued. In the long run, the market price will be, in economic theory, in the long run, all market prices will converge to equilibrium price, which is attained when the fair value or the rational price is obtained at the equilibrium, because when there is equilibrium, when it is in equilibrium, what does that mean? Demand and supply are in equilibrium. In other words, there is no surplus, there is no excess demand or excess supply, right? And then the price settles at the long run equilibrium price. But that long run equilibrium is actually a theoretical thing, because even if it reaches equilibrium, right, it doesn't stay there. In other words, every minute, every hour, every minute, the market price changes, right? Short-term demand and short-term supply will be, out of equilibrium. So even if you reach a long-run equilibrium, it's only very transient. it doesn't, last very long. So I mean, think about it. Tesla, everybody knows that Tesla is very hot. And how much is Tesla? I think Tesla reached, something like almost $2,000. Uh, let me quickly check. Where's Tesla? Tesla. TSLA. Yeah, Tesla is trading above $2,000. It's actually 2015 at this time, at this moment, but nobody would. Do you think $2,015 per share is a fair value? Is it intrinsic value of Tesla? No, no, it's not. And what is the intrinsic value of Tesla? Um, my valuation of fair value of Tesla is about around $80, a bit somewhere between 80, 87, near $90, 87, 85. So this is grossly overvalued. But then who's gonna who's gonna control it? I mean, it's the market price has nothing to do with actually. The market price should, if the market has a perfect foresight, and if market is rational, right? The market price won't deviate that much from the fair value. Okay, but who cares? I mean, if you bought Tesla when it was $400, aren't you going to be happy if it is trading even like last year about early last year it was about September last year was only about $400. But if you bought it for 400, and even at the time 400, it was grossly overvalued, because at around that time when I calculated it, the fair value, intrinsic value was only about 20 something. But then market is irrational in the short run. Market is, in other words, crazy. They don't care. While the bubble is, blowing, and it's, the bubble is going to burst at some point. But while you're still, riding the crest of the bubble, or you don't care. You're just happy that the price is that overvalued, because you think you'll know the perfect timing to sell, and then bubble's gonna burst, but you want to maximize, you want to take advantage of that as long as it lasts, and you don't know when it's gonna burst, but you're hoping that you will be able to exit right before it bursts, but you don't know when that's going to happen, so you keep riding it. You cannot bail out at this time. It's too soon. So nobody cares what the intrinsic value is, even if the price is so crazy. You're happy that the price is that overvalued, right? But once again, why is this important? Why do we need intrinsic value? Look, without the intrinsic value, right? This is market price. And this is rational price, or intrinsic value, fair value. So that symbol, right? There's a need for there's a need for making a distinction between the two, right? But how do you know if anything is overvalued or undervalued? Hmm? You know it's overvalued or undervalued because we know what is the intrinsic value. And that's why we need to calculate, or we should be able to price it. Pricing model means the model to find intrinsic value or the fair value or the rational price of an asset. Why? Because in the short run, a lot of assets, a lot of securities are mispriced, right? And sometimes mispricing gives opportunity to make profit, right? But why? Because if you can spot something that is undervalued, right? And what does that mean? Market price is below the rational price, and that's undervalued clearly. And whatever is undervalued is a buy target, and something that is undervalued will eventually appreciate, right? It will rise in value to settle at the rational price, right? And the reasoning behind it is simple. If you can find something undervalued, then it's not only you. The market will soon catch up. Market will realize that this asset is undervalued, and they will all fall in. They will all fall in like crazy. And as they fall in, what does that mean? It's a buy demand, right? And the buy demand will do what? It will automatically push up the price. Right? Buy demand builds upward pressure on the price. The price will go up, and the rise in price will stop exactly where, exactly at the rational price or intrinsic value, because beyond that point, then it is overvalued. If it is overvalued, there's no incentive to buy, right? So it stops where the incentive runs out, right? So that's why mispricing is a source of making profit from the financial market. And if you're currently holding Tesla, which is above $2,000, you paid $400 a year ago, and this is if you sell it now, this is definitely you make profit of like $1,600, which is like 400% return. I mean, in terms of net return, it's going to be 300%, right? In terms of gross return, it's 400%. Now, but again, so let's say bond price is quoted, right? And of course, the market price would be different from the rational price. But in an ideal universe, let's say market price is the same thing as, in an ideal universe, everyone has the perfect foresight. Market has the perfect foresight. So the price will always be in equilibrium. The price will always settle at equilibrium, and that equilibrium price is rational price. And that's ideal universe assumption. Of course, we don't live in an ideal universe, but let's say, the price, we know, okay, let's say we calculated the price of the bond, and it is, let's say, $965, let's say, right? And if the price is $965, and let's say 10 years still left to maturity, how is this bond called when the price is selling at $965, which is less than the maturity value or par value of 1,000, right? If it is if it is selling below par value, what's it called? You remember? It's called, discount bond, right? Okay, if the price is above, this is below par value, right? Or maturity value, right? I'm not gonna uh, use, P. I won't use PV because you might say, oh, doesn't PV mean par? No, PV means present value, not par. If you just think about the acronym, of course, par value can be, um, symbolized by, PV. But again, then it's confusing with, it's conflicting with present value. I mean, I cannot use, think about it, if I use PV here, that's the PV of PV, present value of present value, right? It can be misleading. So par will always be just, it will never be initialized. It will never be abbreviated. It will always be spelled out. But if you initialize it, or if you if you initial it, how would you do that? I would use, MV, maturity value. Okay. Now, if the price is below the maturity value, then it's called discount bond. And the other case, if the price is above, that's called premium bond. But but think about it. If the price is quoted based on this formula, right? So you calculated this formula, but that price is only it's called actually, a flat price or clean price. Why? So suppose, you saw this bond and you want to buy it, but then the bonds, you understand, bonds pay coupon interest every 6 months, and so it's been how many days? Last time the coupon was paid, right? Last time the coupon was paid, that was, let's say, 3 months ago, or 2 months ago. Let's say the coupon was paid 2 months ago. So the next time the coupon will be paid will be 4 months later. So if you buy the bond now, you cannot just pay the flat price or clean price. Why? Because the seller was holding this bond for 2 months, right? So since the last coupon payment, so the next coupon payment, right, which will happen 4 months later, but at least one third of that next coupon interest payment belongs to him. Make sense? Right? So, and then next 2/3 of the next coupon interest will belong to you. So how do you split this? I mean, when you receive the coupon interest, 4 months later, will you find this guy, this seller, and wire the money to him? No, that's not gonna happen. It's not like it's a very a complex society. You cannot, and this person doesn't want to leave his personal information. So when they sell it, then the price will have to include the accrued interest up to that point. So actually, what you will pay will be the clean price, right, or the flat price plus the interest accrued, right? So you'll pay that. That's called invoice price. Okay, and the invoice price is the also called the dirty price. Okay, that's interesting, right? It's called dirty price. But anyway, this is the reason we need to go one step further, because in Finance 100 you learn how to calculate the intrinsic value, but in reality, when the transaction happens, when the actual trade happens, right? Then the price will have to uh, uh, take that accrued interest into account, right? So we're gonna talk more about this and actually do the exercise in the next video. Okay. So every video will be cut up into a 30-minute segment. Okay. So stop recording. I'll see you guys in the next.